Cap rate, which is short for capitalization rate, is a measure of a commercial property's value relative to its income. Let's walk through a quick example. Suppose you're a broker walking around in New York and you wanted to purchase a specific building. Well, you could go to the leasing manager, ask for the tenant rolls, and figure out that this building is expected to earn about $100,000 over the coming year. If you knew that the market cap rate was around 10%, then you know that a ballpark estimate of how much you should be paying for this property should be around $1 million or $100,000 of income divided by the cap rate of 10%. Now, not every cap rate is the same depending on your perspective. Obviously, if you're a buyer, you want a slightly higher cap rate, which translates to a lower purchase price. If you're a seller, you want to negotiate for a lower cap rate, which translates to a higher selling price. As such, the cap rate as taken as a whole, either on a property or by metro basis, gives you an indication of the health of specific transaction markets, especially when you take a look at it over time. Suppose, for example, that the average cap rate for every office building that transacted in New York City fell from around 7% over the course of the year to around 5%. Now, what does that tell you? Well, one of several things. First, it could well be that the market is recovering and that a lot of buyers are flooding the market to basically pay higher prices for New York office buildings. On the other hand, it could also mean that the market is getting frothy. Over the period of 12 months, values have increased so much that don't justify any increase in income depending on where that variable is heading. Therefore, what you need to do when you're taking a look at cap rates from an analytical perspective, both from the property and geographical basis, would be to take a look at where both the income side and the value side are moving. You can't just take cap rates in isolation, and whether it's rising or falling isn't necessarily good. You'll want to see where the individual components are heading. Now, given these different perspectives of cap rates from the buyer or seller side and how cap rates might change over time, what Reis offers you would be three different kinds of cap rates. One would be the standard estimated going-in cap rate, which is calculated using an estimate of the future income of a property over the course of the next year divided by the transaction price, given that it sold recently. We'll also give you the 12-month rolling cap rate for the metro, which basically gives you the 12-month average for the metro level cap rate, and that gives you a way to smooth over outliers. Say you had a blockbuster month in September and or November. Well, how does that pan out relative to how the rest of the year went? You'll want a bit more of a balanced measure. And finally, to the extent that the buyer or seller or other industry source reports it, we will also give you the reported cap rate. And once you combine these three different measures of cap rate, it should give you a perspective of how much is this property really worth given the kind of income that it's expected to throw off. So that's what a cap rate generally is. That's what we use it for in industry practice. And thanks so much for listening. I hope this has been helpful for you. If you need more information, please visit our website, ReisReports.com.